Hello. Hello. Audible. Audible.
Yes, sir.
Enough. Volume is enough. Hello. Hello.
Yes, sir.
Volume is enough, right? Okay. Yes. Trading account. Satvik. Satvik. ಇಲ್ವಾ
ಹೇಳಿ ಸರ್.
ನಿನ್ನೆ ಏನೋ ಇದು ಏನೇನು ಏನೋ ಸಮರಿ ಅಂತಿದ್ದಿಲ್ಲ ಏನದು?
ಇಲ್ಲ ಸರ್, ಜಸ್ಟ್ ಮೇನ್ ಪಾಯಿಂಟ್ಸ್ ಹೇಳ್ತೀರಾ ಅಂತ ಕೇಳ್ದೆ, ಬೇಡ ಬಿಡಿ ಸರ್.
Okay, we will start with trading account. And this is non-manufacturing, right? That means generally what we mean by non-manufacturing means trading. One who buys and sells the goods, that is known as trading. Okay, he is not producing anything. Hence, his gross profit will be the selling price minus cost of goods sold. Means he buys the goods, he spends some money on bringing or storing and all, no, that is his cost of goods. And he will spend some sales expenses also he will do. The net of selling price and purchase price plus expenses done, okay, that is known as gross profit. This is a format of a trading account. On the, see, opening stock, added purchase price, then direct expenses, whatever it will be added. From there, cost of goods will be deducted. That will give you closing stock. Huh? This closing stock, that will not give you closing stock. From there, closing stock again will be subtracted. What is left out is gross profit. If there is a deficit, that means sales price is less than the cost of goods sold, that is known as gross loss. Okay, that is known as gross loss. See, this is the ledger account format of the trading account. The period year ended, for example, 31st March 2020, 31st March 2021, coming year, all these will be here. Then see, sales will be written here. Anything returned by the customer will be subtracted, and closing stock will be entered. Then on the left side or debit side, opening stock, purchases, there also any returns it will be subtracted, net amount here. Then expenses done, direct expenses like freight, carriage, etc., that will be written here. Then you have to find out which side is more in total, either debit side or credit side. Okay, then for the debit side, any wages paid, expenses, these are all name of the expenses. See, it is given that direct expenses, freight, carriage, one possibility, another customs and insurance, another possibility, transit insurance, there is a insurance called transit insurance. Then wages, if anything paid, gas, water, fuel charges incurred, or factory expenses, anything is there, because these are all for the manufacturing, factory expenses and all. Otherwise, it will only be direct expenses like freight and all for the purchases. Then all this will be added. Okay. Then which side, credit total is more or debit total is more, you have to find out. If, see here, my cursor, if credit total is more, first this total will be made. See, previous slide, see this, and this, whatever it is, total will be made. That total will be written here as well as on the debit side. The difference will be found. That difference will be gross profit carried down. CD means carried down. In case debit side total is more, that total will be written here. Same total will be written on the credit side. Then the difference in the credit side will be found. That is gross loss. And it will be written as by gross loss carried down. Okay. Almost all you have done this already. Okay. And This is texture explanation. What I have told is here. Opening inventory, purchases are written on the debit side. Sales, closing inventory on the credit side. Any expenses and all will be written on the debit side of the trading account. Then this which side total is more, that will be found. The difference will be found. If credit total is more, then it will be gross profit. If debit total is more, then it is gross loss. That will be carried to the P&L account, profit and loss account. Gross profit will appear on the credit side of the P&L account. Gross loss will appear on the debit side of the P&L account. Okay, I'll come back. Then these are all the entries which will be on the debit and credit side of the trading account. That is told here. Again, to recall, opening stock, that is opening inventory, purchases, if any less returns, minus less returns, that is minus returns, and expenses done for purchases, etc. Then on the credit side, sales will be written, net less returns, then closing stock, that is closing inventory, will be written. Okay, that is trading account items. Opening inventory, purchases, purchase returns, carriage, freight, etc. Wages, anything, sales returns will be there. Closing inventory will be written. Okay, yeah. Hmm? If any damaged, obsolete items are there in the stock, that will be taken out. Okay, yeah. Then valuation of inventory, already we have studied. Different types are there, which is to be adopted. That is left to the intelligence of the management and the chartered accountant, based on the experience of the industry and based on the experience of the business enterprise. Hmm? I will come back. Okay. Yeah. Then before this, what are the closing entries? What are the meaning of closing entries? This much you will take the photo and you will make a reading also. Any doubts and all, you can ask me. Take the photos, simultaneously read also. Any doubts, ask me. Yeah, from here. Yes. 1 second, hold on. It started from here. Yeah, from here only. Yes. Over. Shall I move? Take this photo. This is horizontal way of presentation. See, I am showing the cursor. See here. For this opening stock, these two are added and these two are subtracted. Yeah. Take the photo. Then I will move. Yeah. Take this photo. This is vertical presentation of trading account. Okay. Yeah. Take this also, that is continuation of that debit side. These are all, see, these are all debit side continuation. As there are no items, it is shown as blank. Then see here, this expenses total is given here, no? Then this also should come here. That is typing, just it has went there. Because the difference of the credit total and debit total is this two gross profit carried down. Only one appear means, see here, shown gross loss. Either loss will be there or profit will be there. Both will not be there in one single trading account. That is the meaning of only one will appear. Okay. I believe you have taken the photo. I will move. Yeah. Take this also. Read. Yes. Next. Take photo. Okay. Yeah. 1 second. Yeah. Take closing inventory. See in the question, listen to this. In the question, if the trial balance is given and closing inventory is shown in that trial balance, that means closing inventory is taken into consideration while preparing the trial balance. Hence, that closing inventory will be entered or shown only in the balance sheet asset side. Whereas, if it is given in the question after the trial balance, in the bottom, after the trial balance, additional information or adjustments, and there 1, 2, 3. In that, if closing inventory is mentioned, then that closing inventory should be taken to trading account credit side as well as asset side of the balance sheet. Remember this. That is the meaning of this closing inventory and its valuation. What is given there, explanation, that is the meaning of that. Clear? Yeah. Move. Yeah. Take this photo and move, read it. 1 second. Yeah. Take the photo and read it. In inventory valuation lesson, we have studied that the cost or net realizable value, whichever is lower, will be taken as value of the inventory. Yes, time is enough, I believe. Yeah, take this photo and read it. See, the last sentence meaning is that gross profit, if it is known, and sales, total sales, if it is known, the difference between those two numbers will be the cost of goods sold, because cost of goods sold will have some part of the sales expenditure also. Hence, sales minus sales expenditure is net sales, that is cost of goods sold. In that, gross profit content also will be there, part of the cost of goods sold in the inventory, closing inventory also, because inventory, closing inventory valuation is at the cost, whereas sales will have cost plus sales expenditure plus gross profit, that is profit also will be there. For the total sales, if you add that, that will express how it is cost of sales or cost of goods sold, gross profit, as well as sales expenditure, closing inventory, all these together credit side total. Yeah. Then coming to closing entries. Closing entries meaning is that once the trading account is prepared, you have made the entries on the debit side, credit side, and all. For that, journal entries, whatever the balances are brought from the previous year, that is closing balances of the previous year. For example, closing inventory of the previous year is opening inventory of present year. Huh? For that, opening inventory should be made, and at the end, closing inventories, journal entries, not inventories, journal entries. Hence, closing entries in respect of trading accounts are, for opening inventories, trading account is debited, inventory account is created. Then what happens? You see this opening balances, that is closing balance of the previous year, opening balance of the present year, will be on the debit side of the trading account. That last year's that entry will close down. Here it has come to trading account. For that, a journal entry. This is a journal entry. And purchase returns, return outwards, because purchases returns means goods will be going out, right? Hence, returns outwards account debit to purchases account, that is credit. This is a closing journal entry. Whatever the numbers, figures, it will be return amount. Then return inwards. Return inwards means what? Sales returns are return inwards. Okay. Hence, debit sales account, credit returns inwards account. This is a journal entry. While writing the trading account, you are subtracting this from sales, this figure. For that, journal entry, this is purchase account, debit trading account, credit purchases account. That is net amount, that is after you deduct the returns. Okay. And expenses, debit trading account, credit the concerned expenses accounts. individually. See why it is, because when you have paid the expenses, when remember, recollect, this is professional studies. What is the difference between in general plus 2 and professional studies is like that. See here, when you have paid the expenses, you have debited the expenses account and created the cash or bank account. Now that is still that account is balance is there, no? To close that balance, that is transferring to the trading account, you are passing this journal entry. Debit trading account, credit the expense account. Now what happens? When you paid the money, expense was debited. Now you have credited, means that account will close down. Where it will reflect now? It will reflect in the debit side of the trading account. This is the logic, reasoning, understanding like this way. Okay? In sales also like that. Sales account debit, that is for net amount after returns and all. Trading account credit. On the credit side of the trading account, you are writing. In the accountancy language, why you are writing on the trading account is because this journal entry posting to that trading account. Trading account is a ledger account again. Then closing inventory, debit inventory account, credit trading account. Once you prepare the trading account, from there itself, it will be easy to write the closing entries. Then see, this is summary of what is told now. Trading account data to opening inventory, to purchases, to wages, to freights. Likewise, sales account debit to closing inventory, debit to trading account. These are all, you know it, called compound journal entry, correct? When you have one debit or multiple debits and one credit, or one debit, multiple credits, it is called compound journal entry. First PUC you have studied, right? Okay. Now, difference. If credit side is more, trading to profit and loss account, that is representing gross profit. If debit side is more, then this is, yeah, profit and loss account to trading account. That is, this represents loss, gross loss. This represents gross profit. Again, both journal entries will not come in your closing entries. Either this will be there if there is profit, or this will be there if there is loss. Okay? Yeah. Then P and L. Before that, this much you do. Yeah. Closing entries. Take the photo, read it. Any doubts, ask me. Okay. Next. Yeah. Okay. Yeah. Take this also. Okay. Yeah, take this. Okay. Now, profit and loss account, what we call P&L account, P&L account in general. Okay. See, all the expenses other than related to purchases and sales, sales related expenses also will come other than purchases expenses regarding administrative expenses, etc., salary, rent, etc., will be shown on the debit side of the profit and loss account. First, gross profit. If gross profit was there in trading account, that will be written on the right side of the P&L account, credit side of the P&L account. If it was loss, that will be written on the debit side, left side of the P&L account. Then all the expenses and losses, whatever it is, will be written on the debit side of the P&L account. Whatever the gains, profits, incomes will be written on the credit side of the P&L account. Then it will be verified whether debit total is more or credit total is more. If credit total is more, the difference between credit total and debit total will be written on the debit side to net profit carried down to balance sheet, or the word capital can also be used. If debit side is more, that total will be written on the credit side total. The difference between that total and the numbers in the credit side difference, that is, will be written as by net loss carried down to balance sheet, or net loss transferred to capital. These words will be used and written. Okay. See, this is how it is written. Profit and loss account. See, these both will not be there. Any one will be there. Either this entry or this entry, depending on whether profit or loss. Gross profit means this entry will be there. Gross loss means this entry will be there. Then all the expenses. See, these are all broadly called management expenses. Salaries, rent, printing, postage, insurance, etc. Maintenance, that is repairs, renewals, depreciation, these are all known as maintenance expenses. And I'll come back. Selling, distribution, spent for the sales and all. And if any bad debts is there in that sales, all these provisions made will be coming here. Bank charges, interest on loans, discount on bills, etc. is known as financial expenses. Then if any abnormal losses, sometimes machinery, old one sold, realized value is less than the book value, or because of fire and all, that is abnormal losses. Okay. Next, that is net profit, I told you, like that. And on the credit side, discount received, commission received, etc., known as other income. Then non-trading, like bank interest received. If investments are made, then interest will come, no? Or if investment made in shares, dividend will come. That will be non-trading income. Then any abnormal gains, an old machinery is sold and realized value is more than the book value. That is an example. Or investment made, say, say around 3 years back, sold now, realized more than the invested value. Those are all gains. Abnormal because it is not regular gains. hence it is abnormal case. All these are written. If this debit side total is more, then it is loss. If this credit side is total is more, then it is profit, which will be shown like this. Here also like that, either net profit entry will be there or net loss entry will be there. Both will not be there in the same account. Okay. Hence, this is what I told you just now. Yes, given here. Okay. When we come back, you will read this. Yeah, same. And see, drawings of the proprietor or interest allowed on his capital or charges he charged for his personal services done to the firm are not taken in the P&L account, but there will be an account called, see, drawings, income tax paid, discount received and allowed, rebate, etc., bad debts. Those will be taken in appropriation account. Another appropriation account will be there, or it will be shown in the balance sheet itself. That will be deducted from the capital. If drawings, these will be deducted in the capital. Income tax payable or paid. Paid will be shown in the profit and loss account generally. Business income tax. Provision will be deducted in the capital. That you will see in the next. Then like that, closing entries like trading account also will be for profit and loss account. All debits done. P&L account debit to those heads, all expenses heads, and all incomes debit and credit to the P&L account heads, all income heads. Okay, see, then it will be transferred. Net profit will be transferred for that entries P&L account debtor to capital account. In case of loss, capital account will be debit and P&L account will be credit. Okay, adjustments, again I will come back. Before that we shall do this much. Yeah, from here start. Take the photo, read also. Any doubts, ask me. See here, given last sentence, only those revenue expenses and losses which are related to current year debited to P&L account. What about outstanding expenses, means that should have been paid during this year but not yet paid, or income which relates not to this year is also received already, which relates to next year, that will come in the adjustments. I told you, no? After that, there are adjustments that we will study in that heading, adjustments. Okay. Yeah, take this photo and read also. Okay, this you simply take the photo, later you can read. Take this is continuity of that.
Go back, sir.
Yeah.
Yeah, sir.
Okay. Yeah, take this.
Sir, while writing, we have to put the headings and write, sir. Selling and distribution expenses.
Better
Not
if you
required, no,
write.
sir.
Better if you write. Otherwise
Yeah,
also
sir.
no problem. That is to make you understand actually that financial expenses, abnormal headings are there, no? What type of expenses it is, related to what. Because in salary, for example, administrative salary and selling employees' salaries, it will not be bifurcated in general. It will be going to the salaries only totally. Okay. Fine. Yeah. Enough. Huh? Yeah. This also take the photo and read. Okay. Yeah. Okay. Yeah. Take this photo. That is continuation of previous one. Yeah. Read this and take. Okay. Yeah. Again, as I told you, in this, any one set will be there, either this or this, because simultaneously there cannot be profit as well as loss. That is why. Yes. Now, adjustments. What are the adjustments? As I told you, suppose the rent of the March month is not paid till the end of March 31st, that is end of the year, then it is known as outstanding expenses. In the P&L account, such outstanding expenses will be added to the head of the expenses. If any expense is paid in advance, for example, suppose next April and May expense is already paid, rent is paid in the month of March itself, maybe to some reasons, that is relating to the next period but not to this period, but paid in this period itself, then it is known as advance payment. That will be subtracted from that payment made less those 2 months rent. That is known as prepaid expenses. Heading is prepaid expenses. Not yet paid but due, outstanding expenses. Not due but paid for the next period, paid in this period itself, known as prepaid expenses. Likewise, for income, income received in advance or outstanding income will be given the same accounting treatment, of course, on the credit side of the P&L account. That is what I told is here, journal entry. When you come back, when we come back, you will read it. Likewise, any subscription paid in advance, that is expenses, prepaid, all will be done in the same way. Accounting treatment will be same. And in case of inventory, stationery, advertisement, etc., will be there, no? Stock held, that also will be done the same way. Inventory of materials to appropriate expense account. Bad debts, there are two types. One is bad debts, another is bad debts provision, another is recovery of bad debts. See, bad debts means sales done, credit sales, it is definite that that much money will not be received. Say for example, Mr. A will not pay, that is certain, sure, that is called bad debts. Provision is done when it is doubtful, may receive or may not receive, then a provision will be made. Suppose bad debts is written off, bad debts debited already, or provision is done, but in the next year, maybe next financial year, some part of that is received, that is called recovery of bad debts. Say for example, this year one company has made 25 lakhs as bad debts shown in the profit and loss account. Out of that, suppose next year after 6 months, suppose 2 lakhs received, that is bad debts recovered. Okay, how the accounting treatment is given? See this way. This is debited to profit and loss account, provision, as well as bad debts will be debited in the profit and loss account, and customer's account, it will be written off. That means that much which is to be received from customer, no, that will not be received. Hence, that customer account will be given that much credit, and that account will be closed. Likewise, for discounts also, if it is expected that discount is to be given, offered to the customer for increasing the sales and all, provision may be made. That is, provision is created in the same manner, that is like previous slide what we have studied about bad debts provision and all. Amount of provision is required to be calculated after deducting the provision for bad debts from total trade receivables, because discount will not be given for the bad debts because money is not received. If there is a cash discount offered for getting the money at the earliest possible, if the money is not received, that discount will not be given, right? That is provision for discount. Then depreciation, depreciation will be debited to the P&L account. We have studied all in this study of depreciation. One lesson was there, no? We have already done. That depreciation amount will be debited to the P&L account. At the end of the year, depreciation balance, that depreciation ledger account balance will be transferred to the P&L account. That means in P&L account, P&L account debtor to depreciation account. Then if any other provision means if anything is expected that there may be a failure to get the payment and all, such provisions will be done. The provision for bad and doubtful debts and provision for discount on trade receivables deducted from the total book debts. Total book debts meaning is that sundry debtors, what we call it sundry debtors or trades receivable, that's all total book debts. The other word, total book debts, the other meaning, other word used, similar words for sundry debtors, total debtors, trades receivable, total book debts. All these four are same meaning. Okay. Then if any, we have studied, no, correction of errors, rectification of errors we have studied. If anything is there like that, suspense account, where it arises in case of trial balance disagreeing, right? Difference in the trial balance. If suspense account is opened and all, no, such transfers also will be done. How it is done and all we have studied in case of rectification of errors. Okay. Then about abnormal loss. This again, anyhow, I have to take it tomorrow only. Today time will not be enough. Anyhow, we will see. Abnormal loss of inventory. We have studied what is abnormal loss, how it will be accounted, right? Abnormal loss will be debited to the P&L account. We have studied. Abnormal loss will be calculated, and journal entry will be P&L account debit to abnormal loss. Then goods sent on approval. We have studied. At the end, if confirmed, approved means it will be treated as sales. If not, that will be treated as closing inventory. We have studied it when studying the lesson sent on approval basis. Okay. And goods used other than for sales. Sometimes free samples, example, free samples will be given to promote the sales, to increase the sales. Free samples. Cost of such goods will be debited as samples or advertisement expenses to the P&L account. And that much goods value will be reduced in the closing inventory. For example, think in this way, toys, baby toys selling, right? Suppose there is a closing inventory of 5 lakhs rupees worth toys. Say in a year, they have used 50,000 rupees worth toys to give as free samples. Then when say samples given, no, that much physical goods will come down in the stock, right? Hence that much should be reduced in the closing inventory. And double entry bookkeeping. where is the other effect? That will be as an expense on the profit and loss account debit side. It will be shown as expenses, samples or free samples, or that is for the promoting the sales, which meaning is that advertisement. That is also a form of advertisement. In that way, it will be shown in the profit and loss account debit side. Then commission based on profit, to motivate the consignee or the agent, a commission will be paid on the amount of sales he does. That will be calculated based on the sales value. That sales value will include this commission also. For example, if the commission is 5% on the sales value is 100 rupees, means on that 100 rupees, 5 rupees commission. That means 105 rupees sold includes 100 rupees plus 5 rupees commission. Then whatever the sales value is given, commission calculation is that sales value given divided by 105 multiplied by 5. That gives you commission, amount of commission. If you want net value excluding the commission, that sales value divided by 105 multiplied by 100. That gives you net value of sales excluding the commission. Are you able to follow this? Because question will include such adjustments. Are you able to follow? Say commission given on the net profit of that. What you will do in P&L account? You will write all the credit entries, debit entries in the P&L account. Then what is the difference? No, that represents the net profit plus commission. I gave you example of 105, 500. No, that example. It will be more clear when we do the sums, illustrations we do. Okay. Yeah. Calculation, just now I told you, no? Calculation, see, profit before commission divided by 100 into rate of commission. See here, profit before commission, 100 plus, that is what my example, 105, then 5 rupees, right? When profit calculation is before commission and before net profit, before charging the commission, this formula. If net profit is after charging the commission, this formula. Journal entry is like this. Commission account debtor to commission payable account. This will be transferred to P&L account. Okay. See, profit and loss account debtor to commission account. Okay. This much. How much time is there? Yes. It may be delinked for tomorrow's class, hence patapat you will use 2-3 minutes, take the photos so that you can revise at home and find out the doubts and ask me tomorrow. Doubts, clarification tomorrow. This P&L account what we have just now, adjustments part. Hence, just to revise it, take the photos only. Okay. Clarification, doubts, clarification and all we'll do tomorrow about this adjustments part. Yeah, take photos, 2 minutes, 3 minutes. Take patapat photos, only photos. I will move. Someone say after the photo, yes, yes, so that I will move.
Yes, sir.
Take this photo.
Done, sir.
One second. Take this photo.
Done, sir.
Take this photo. Done now, just now. Yeah. Next. Take this. Okay, take this photo.
Done, sir.
Yeah, take this photo. Oh, this was also there. Yeah, take now. Again, take a photo. Take a photo again. So that previous photo you can delete. Yeah, take this photo. Yeah, 1 second. Yeah, take this photo. Take this. 1 second, 1 second. Take this. Okay.
Done, sir.
Yeah, this one. 1 second, 1 second. This one. Yeah, this one. Okay, this one. Yeah, this balance sheet we'll do tomorrow, and still this. Okay, and this adjustment what I have told you, that you read today. Any doubts, difficulties, you ask me tomorrow. After that, I will start the balance sheet tomorrow. First, I will clarify the doubts, anything is there, then I will start balance sheet. Okay, fine. Bye. Take care.